Welcome to today's event with Brian Wesbury, Chief Economist from First Trust Advisors. Brian and First Trust is known for providing the antidote to conventional wisdom. There's a lot happening, and it's no wonder investors are confused. We're going to dive into a lot of questions today. Hopefully have some answers for you. Carver Financial was founded 30 years ago to make people's lives better. Today's event is part of our 3-decade effort to inform and update you with relevant information, cutting through all the noise. We understand that market volatility, political turmoil, and all the negative media can raise questions or be unsettling. I've been in the financial services industry for more than 34 years. Corrections, uncertainty, and even pandemics are not new, nor is a reaction of the markets. What is different now is the amount of conflicting and simply wrong information. The degree to which politics has become partisan, and also the pace of change. 30 years ago, we didn't have social media or instant access. We're extremely privileged to have Brian Wesbury joining us today to chat and truly provide insight into where we're at and where things may be going. Brian is Chief Economist at First Trust Advisors. The Wall Street Journal ranked Brian as the nation's #1 U.S. economic forecaster. Brian was a member of the Academic Advisory Council of the Federal Reserve Bank of Chicago and served as Chief Economist at the Joint Economic Committee of the U.S. Congress. Brian has 2 books, The New Era of Wealth and It's Not as Bad as You Think, one of my favorite books. He's a frequent guest and contributor on CNBC and writes for the editorial page of the Wall Street Journal. Thanks, Brian, for joining us. It's great to see you again.
Randy, it's always great to see you and to be with you, and thanks for asking me here today.
Awesome. So, Brian, it's apparent that the Democratic Party substantially beat expectations with regard to both the House and the Senate in the election. In your opinion, what are the tax and economic implications of the election, perhaps more broadly? And how much impact does Washington really have on the markets and the economy?
Yeah, Randy, this is obviously, this is a $64 million question, I guess we used to say. And I would argue that if we look at just the past few years, Washington has a great deal of impact. I mean, when we can shut down companies for a pandemic, when we can stop services, when we can borrow $5 trillion and print $4 trillion, it's pretty clear Washington can have a major impact. I personally believe that we made a lot of mistakes, that locking down the economy, not educating our children, we ended up draining the Strategic Petroleum Reserve, borrowed $5 trillion from the future. All of this, I think, has made the U.S. a little less safe, if you will, in the future. We used a lot of our dry powder. Having said that, I'm not trying to beat up on Democrats or Republicans. One of my beliefs is that no matter who you vote for, it seems like the government always wins. And that is, government spending has gone up pretty consistently for 90 years. I do believe now that we have a divided government. The Republicans will take the House, that we will not have tax hikes in the next 2 years, that we will not have any real new big spending bills, and actually regulation is probably going to be damped down. So the market tends to like divided government, and I'd put myself in that camp. That doesn't mean we won't have a recession or the Federal Reserve won't raise rates too far, but at least from a political point of view, divided government means less activity. And after the last couple of years, I think that's something that I'd really like to see.
Yeah, I think all of us would like to see that. So, You having been in the industry 30 years, it's clear, at least to me, that the equity markets tend to move on perceptions in the short term, but fundamentals in the longer term. So I
Right.
guess what's your opinion on where we're heading in the next couple of years from an economic fundamental standpoint?
Right. What you bring up here is a perfect. In the last few months, I wish I could tell you exactly how many days or weeks it's been, but we've had a massive rally in the U.S. equities markets. I think it's based on a couple of things. Number one, the market thinks that the Federal Reserve is getting close to ending its rate hikes. And number two, it was about the election, that we're going to get to a divided government. However, here's the problem, and that is that profits are likely to decline next year. And I want to explain that just real briefly. We by borrowing and printing all of that money, it's almost like we can think of the pandemic like a car accident. We had a car accident. We broke our leg in 3 places. It really hurts. The ambulance shows up and they give us morphine. And when we get transported to the emergency room, the doc comes by and slaps you on the shoulder, and she says, get ready. You're about to go in surgery. How do you feel? And you go, I feel great. And that's because you're on morphine. And she's like, well, you're not great. Don't get up. Your leg is broken. We have to fix it. And that's where we are today. If we really look at, for example, personal income, the earnings of all Americans from February 2020, just before the pandemic, to today, they're up 2.6%. But personal consumption is up 6.6%. In other words, consumption has risen 3 times faster than incomes, and it's because we borrowed money from the future, from our kids, if you will, and we handed it out. And in many cases, we were actually giving people unemployment benefits that were greater than the earnings they would have made over the same period of time. So that overspending, because we borrowed, has to go away. And in my opinion, there's no way that we can have a correction from this distortion, or, to finish off my analogy, that we can come down off the morphine without feeling the pain. And that's what I expect next year. I do expect a recession. I expect lower earnings. And I think this rally in the stock market will stall, and we're going to see the market decline at least over the next 6 to 9 months.
Okay, yeah, and it seems that markets can certainly handle bad news, but they hate uncertainty. And once you get some
Right.
clarity, things tend to stabilize. I'd agree. As far as the election, kind of like in 2020, they shut the economy down, and yet the market rallied.
Right.
So, what do you feel, not just in 2023, but looking ahead, is probably the
Right.
biggest risk that investors are facing, and what should they be doing, if anything?
Yeah. So your example of 2020 is it's perfect, because in March and April, we locked the economy down. 15 days to slow the spread turned into more. Services were closed. You couldn't go to sporting events, airlines, like restaurants. I mean, it was an amazing event, and the market plummeted. Uh, at the bottom, I was saying this is an overreaction. All the money printing that the Federal Reserve is going to do, all the borrowing that we are going to do, is going to bring us back. And in fact, corporate earnings, profits, went up 23% between the end of 2019 and the last quarter that we have, which is the second quarter of this year. So we've had a massive increase in earnings. The question is, in my mind, how much of that is due to the morphine? So that's why the market rallied, even though we had COVID. It was because we we gave the economy morphine, all the spending, all the borrowing, all the money printing. Now the question for me, we've never done these things before, Randy. That's one of the problems. And you talked about uncertainty. So the question is, how much payback do we have? Are earnings going to decline by the same 20% next year? I don't think so. And I think also that the Federal Reserve is likely to turn around and cut interest rates, or at least stop raising them once the economy gets into trouble. And I believe I just a recession has to come. We artificially stimulated the economy during a period of time when it was mostly closed down. In other words, we should have had a recession over the last 2 years, but we didn't. And so I think that pain is going to come in 2023. Now, here's the thing, that eventually, once that happens, we've had the artificial stimulus, then on the other side, we get the pain. We will move through this. And I believe 3 to 5 years from now, we will be at a new market high. We have such great technology, such great companies in America. We are the best economy in the world. And as a result, I think we will recover, but it's going to be a rocky road to get there. And the only doubt I have about this forecast is that if investors look right through what's going to happen in 2023 and early 2024 and start thinking about 2025 and 2026, we might not feel as much pain as the economy actually experiences. In other words, the market might say, I know the economy is not as great. We're in a recession. Unemployment is up. Housing is down because of higher rates. All these things are true. Earnings will fall this year, but we expect them to recover in the next couple of years. So I personally think we're going to have a rough road for the stock market over the next 12 to 18 months. And then after that, it will get better. But you never know, because sometimes investors just look right through all the pain and ignore it, just like they did during COVID.
Yeah, I think it's interesting you mentioned tech, because that's always the X factor. Plus, it seems like, as dysfunctional as our government is, it's very stable compared to certainly the rest of the world,
Right.
as things come in. So I think, it's interesting. You talk about a coming recession, and I think people have to differentiate between an economic recession, 2 back-to-back quarters of negative GDP growth, what I call a real world recession, where restaurants are empty, airports are empty, which clearly is not the case.
Right.
So where do you see, we asked about what the risk is. Where do you see an opportunity for people today? And what do you think they perhaps should be thinking about doing?
Yeah. This is going to be kind of a geeky economic thing to say, but one of the things we said that we saw during the pandemic was that the Federal Reserve printed 42% more dollars. That's how many more dollars are circulating in the U.S. economy today. And so if we think about it this way, if you have a bumper crop of corn, then the value of corn goes down. And if you have a bumper crop of dollars, the value of the dollar goes down. So I was talking to a friend of mine the other day, and she said, pizza costs more. And I, being the economic geek that I am, I said, your pizza doesn't cost more. Your dollar buys less. And what I was getting to is that you can't print 40% more money without having inflation. And that's exactly what we've seen. And my belief is that the economy has to absorb all of this money. In other words, inflation will be here for longer than people think. Now, that doesn't mean that gas prices are just going to keep going up and up and up until they're $20 a gallon. But my belief is that commodity prices, oil prices, let's say, are going to be higher than they were, and it's a permanent thing. And what this means is for certain sectors of the economy, let's say materials companies, which would include the energy sector, even at $70 or $75 a barrel, or even $65 a barrel, oil companies and natural gas companies are going to be able to make a lot more money than the market expected just a year ago. And that's why their stocks are up. I still think they're going to perform well. If you're a company, for example, if you think of a hotelier, you own hotels, not just manage them, but own them. Imagine how much more it would cost for a competitor to build a hotel near you and compete today than it cost you to build your hotel 5 years ago. That's what inflation does. So anyone who has lots of fixed assets, hotels, or $1 billion paper mill, or any kind of massive industrial base, if you have fixed assets and you built them years ago, you're going to be able to sell at the higher prices and have higher profit margins. I also think in this world today, healthcare is a booming industry. Obviously, COVID and the pandemic, it allowed it to expand, but there's new technologies out there. It is going to expand. And at the same time, financials, banks do much better in a higher interest rate environment. So there are sectors that will benefit even though a recession is likely to come, because we have higher inflation. So that is the I guess the one worry I have is that inflation will be higher than people think, and they won't invest accordingly. But the second thing is, if it's high, how far will the Fed go? And if the Fed goes even further, then we might have a deeper recession anyway because of that. So I think one thing to remember, and you mentioned the word uncertainty, is that we have a lot of uncertainty today because we did unprecedented things during the pandemic. Unprecedented doesn't mean it's been a long time. Unprecedented means never have we locked the economy down. Never did we print that much money. Never did we borrow that much money in such a short period of time. And I think there'll be a price to pay. But this is the thing: in an unprecedented times, it's really hard to forecast. And I know that's my job, is to look into the future, and I do the best job I can. And that's why I don't see how we avoid a recession in 2023, because we had a morphine-based economy in 2021 and early 2022.
Yeah, it's interesting because having broken both of my legs, I understand exactly where you're getting. And I think to carry the analogy further, after they fix it, now you need physical therapy, which is really pretty painful till the thing comes back. And I think it's interesting because obviously with the Fed, there's a lag. It's not like you raise interest rates and it affects the economy tomorrow.
Right.
But on the other hand, I think there's a lot of political considerations in the near term. Now, one of the things I think was overshadowed by the election news, and I should say, you were absolutely one of the lone voices that got it right in 2020. So, as we look forward, I think it bears noting, the track record. But I think overshadowed was the fact the federal judge said the president's actions on student loans was unconstitutional. Now, to me, forgiving a lot of student loans is going to be highly inflationary. So I guess the question is not politically, but more from an economic standpoint, or any other thoughts. What do you think are the implications of that?
Yeah, Randy, this is a really important point. Politicians, they push the limits, and I think the student loan forgiveness was definitely one of those. I hate to be, I'm going to say it. I'm not trying to be political. I'm a voter. I'm an American, and I think the timing of it just before the election had a lot to do with the election. In other words, hey, if you think I'm going to forgive your student loans, you're more likely to vote for me or people that will support me. And it was always unconstitutional. The president does not have the power of the purse. That belongs in the Congress. And so the judge was right. The Supreme Court will back that judge up. But there are other rulings by the Supreme Court and other federal judges having to do with the EPA, let's say, taking a rule that Congress makes and then stretching it to hammer oil companies and natural gas companies and fossil fuel companies. And I get the desire for a clean energy world, but electricity does not come from the wall. It has to be made somewhere. And so we are moving closer and closer to getting rid there are all kinds of, Chevron decision is one of them. Look it up, read about it, because the Supreme Court will be ruling on this. And what it will do is it will squeeze the power of executive orders and bureaucracies from regulating the economy excessively. And I think this is one of the reasons why I say that in 3 to 5 years we'll be at new highs, because and this is the power of the U.S. Constitution. You know, people, I hear all the time, democracies only last 200 years. And it's not exactly 200 years, but we get the point, right? If you look back over history. However, there's only one democracy that's designed around the U.S. Constitution. And in my opinion, that's the best governing document of any country in the history of mankind. And it hasn't failed yet. And I believe it was designed well enough to survive. It survived the Civil War. It survived the 60s and 70s. It survived FDR in the 1930s. It will survive today. And this ruling by this judge and the ruling about the EPA and the upcoming ruling about the Chevron decision, I think all lead us away from having too much bureaucratic control, which frees up the economy to be more entrepreneurial. And then let me just say one last thing. You know, one of the other distortions to our economy during COVID is that we locked down small businesses in many states. Yet we left open Amazon and Home Depot and Walmart and Target, the big publicly traded companies, which means any profits that would have accrued to the local bike store, which was kept closed, accrued to one of the bigger companies who was allowed to stay open and could afford to put plexiglass panels up and spray everything down and hire security guards to make people wear masks and all that. So what we saw is the profits, I believe, of publicly traded companies. That was another thing that was artificially boosted. And by the way, that's where we're seeing layoffs. You know, Amazon had 800,000 employees at the end of 2019. Today, it has 1.6 million employees. And what it's finding out is that the growth rate that it experienced during COVID, it's all of a sudden slowed down. And even Amazon is laying off people, canceling new warehouses. And so I think this is the correction to our pandemic policies that we're going to see in 2023. But there is some good news. The divided government, the court's rulings about how far bureaucracies can go in changing rules for society. And I think we're going to end up putting them back in the hands of Congress. And in a divided government, that's a good thing, because they have a hard time getting anything done, even when they're not divided.
For sure. So, switching gears for a second, kind of a broad series of questions that are related. How much of the current inflationary environment do you think is related to fiscal spending versus supply chain issues? And do you think there really are any supply chain issues as related to the Russia Ukraine situation? Or is that more of a kind of a fabricated media type thing? And if you feel the supply chain is truly is a factor, what kind of time frame do you see for some sort of recovery?
Yeah, these are all of this is mixed together. All right. And so I'll just kind of go through it in the steps that I would think about it, given your question. So first of all, government spending itself, just by itself, is not inflationary. In other words, if I borrow from Peter to pay Paul, that means Peter doesn't have the money and Paul does. So there's no new money in the system. That's not necessarily inflationary. However, if that government spending is financed by the Federal Reserve, in other words, I'm not borrowing from Peter to pay Paul, I'm borrowing from the Fed, who is printing money to give me to give Paul, then that's inflationary. And that's exactly what we did during COVID. And that's why the money supply was up 40%. At the same time, I've already said this, personal income was only up 2.6%, spending was up 6.6%. So if you kind of think about it, that's supply and demand, and they're out of whack. We shut down production and yet handed out money for people to spend. And that's why you couldn't get any, and you still have a hard time getting refrigerators and ovens and cabinetry for building. And so all of that, the supply chain issues that we created because we printed too much money, and locked down the economy, definitely were part of this inflation. Plus, Ukraine, Russia, Putin, and Ukraine, oil prices were up. But I guess here's my point: if we would have had all these supply chain issues, and we would have had Putin invading Ukraine, there's what would have happened is there would have been upward pressure on prices. But if we had not printed all that new money, people couldn't have afforded to buy it at the higher prices. So what would have happened is we would have had a recession, instead of inflation. And so it was really the money printing that allowed the morphine that allowed us to feel okay, go out and buy pool tables and boats and everything else. I mean, the stores were empty. Brunswick Corporation makes watercraft. They make, one of the things they make is the river rafts that you whitewater river raft in, or especially fly fishing guides use on rivers. If you're a fly fishing guide, you still have a hard time getting parts, oar locks, or part of the frame that they put in those boats, because they sold out of every part of their inventory. And that was because we were handing out checks and people weren't working. So they went and bought a boat and played on the river. And so all of this played into it. But the real impetus behind inflation was printing too much money. And so, yes, as supply chains heal, as exports come out of Ukraine, and some of that will lower some of these prices, but the money supply that we printed is still there. There's still 40% money, and we have to absorb all of that. So I do expect inflation of about 7% this year. The war in Ukraine probably boosted it a little over 8, and now it's back to 6 to 7 in there. I expect 4 to 5 next year, and 3 to 4 the year after that. And if the Federal Reserve reverses course, back in the 1970s, we had the same problem. We had stagflation in the U.S. economy. And so whenever the Federal Reserve raised rates to fight inflation, then unemployment went up, everybody got mad, and the Federal Reserve cut interest rates, and that just put more inflation into the economy. So we were never able to get rid of it, of the inflation in the 70s, until Paul Volcker came in and pushed interest rates up and slowed down the money supply growth until we broke the back of inflation. And we'll find out whether this Fed has the intestinal fortitude to really break the back of this inflation. I think the jury is still out. I think the market expects the Fed to cut interest rates next year, and they may not be wrong. And if they do, then inflation isn't going away anytime soon. And in fact, it's more likely to ratchet up. That's what happens. We tend to get weak. We make a mistake, and everybody likes low interest rates and easy money. Everybody likes it. I mean, obviously, unless you're a retiree and want fixed income, but then when we get higher interest rates and less money, people don't like that. And the Fed, the more political they are, the more they're likely to feed the beast. And that's why in the 70s it became so bad. And that's the one worry I have about the next few years. Will the Fed actually really break the back of inflation? And the jury is still out on that. That's why I still like materials companies that benefit from higher commodity prices.
Yeah, it's a tough thing because I think, again, in this world, everything's so politicized. And the problem is the impact of the economics takes time, but everybody's in a, instant gratification thing. To further use your analogy, and the question is, do they give another shot of morphine or do they actually fix the problem? And it's going to be interesting because, having a background in economics, obviously we can look at all the numbers. Pragmatically, it's pretty obvious people are spending money because restaurants are busy, airports are busy, theaters are busy, etc. So I guess one question, just a couple more. We hear a lot about inflation as measured by CPI. And certainly Social Security is going up 8.7% next year, which people like. But again, it's indicative of the problem. And I think, people hear the term CPI. Now, personally, I buy more groceries than I do houses. I buy more gasoline than housing. And we look at how CPI is defined. It's roughly, 14% groceries and food and about 44% housing. Do you feel that CPI is actually a good measure of inflation for individuals? Or do you think there's a better measure? Or is there a way to look at, say, CPI without housing costs? But what's your thought as people hear about, because people hear this number, inflation's this, inflation's that. Is it really relevant?
Yeah, we have a bunch of different measures of inflation, Randy. The producer price index, the consumer price index. We have a thing called the PCE deflator. It comes from the GDP numbers. They do it a little differently than the CPI. So we have import prices, export prices. We have all kinds of ways of looking at inflation. It is clear to me that we have had inflation. The value of our money has gone down. And you can tell that because what we're not just seeing one price increase versus another, we're seeing a bunch of them. And then we have to be a little careful looking at individual categories. So for example, used car prices. What happened in the car market during COVID was kind of crazy. So first of all, we locked down air travel and hotel stays and some states stayed more open, Texas and Florida, but the whole Northeast, the whole Northwest, California was shut down. And one of the things that happened was that rental car companies sold all their cars. So they have that's a lot of fixed assets. They weren't going to be able to rent them because people weren't traveling. So they basically got rid of their fleets. So initially, used car prices plummeted. And then once that was over, we weren't building new cars. You couldn't get chips to make them. And as a result, used car prices soared. Now they're coming back down. All of those movements, that's not inflation. That's it's what we call a relative price shift. But when I see all prices tend to rise, I mean, we're talking about everything from food to gas to oil to pizza to all of these things. It's pretty clear there's inflation. Now we could debate whether it's really 5% or it's 11%, but it is a lot higher than it has been in 40 years. And then one last point. I agree. I travel all the time. Hotels are packed. Airplanes, every seat is full. It's hard to get a rental car these days, partly because they haven't rebuilt their fleets. But there is restaurants. It's hard to get a reservation. But don't forget, and I'm not saying this to you, I just in general, people shouldn't forget that we locked down services. You couldn't go to sporting events. You couldn't go to Broadway theaters. Movie theaters were closed. Restaurants were closed, especially in New York City and San Francisco and places like that where COVID policies were a lot tougher. And so what we saw was people, instead of spending on services, they spent on goods. And if we look at goods spending, so the non-services side of the economy, we spent $1.3 trillion more than the trend, than we would have spent if there was no COVID. And that's about how much less in services we bought. So now what's happening is the goods side is going down. Carvana has lost 97% of its stock price. They're laying off employees. Amazon is laying off. We've had tough reports out of a lot of retailers, and it's because they got ahead of themselves. Peloton, perfect example. We shut down healthcare. Exercise places. What do we call them? Anyway, we shut down. You couldn't go to a gym. You couldn't go to the gym, so people bought Peloton. Well, now Peloton's facing the reality that that was not the new trajectory for their sales, and they're coming back to earth. And at the same time, Broadway's opening up, sporting events have opened up, movie theaters. All of a sudden, all these new movies are coming out, and people missed going out to dinner and all of those. So that's caught up. And the question is, how long can that last? And my belief is that when you're raising interest rates, when you're squeezing the money supply like the Fed is doing now, when you're not handing out the same amount of unemployment benefits, because those checks are all out, it's all that money is gone, that even services have to roll over here. And that's why I didn't think we had a recession in 2022 this year, but I do think we will have one in 2023. And that, by the way, this is why we work with you, Randy. We work with financial advisors all over the country, and we have been, and you know this, and you've done this your whole entire career, so I'm not telling you anything you don't know, but asset allocation today is really important, because there were certain companies that think of the big tech companies won during COVID because we needed them to have a lockdown economy and yet still operate in any kind of fashion at all. And so they grew 10 years in 20 months. I don't know how else to say it. And now that's correcting. It's the side that wins with inflation and higher interest rates that's starting to win. Growth stocks won during COVID. value stocks will win in the years ahead, or at least in the next 18 to 24 months. And that's why asset allocation, listening to an advisor, taking the emotion out of things is really, really important.
So, just two last questions, I guess. Um, Certainly, we always hear the term past performance doesn't guarantee future results. Right now, we don't even have past performance because, to your point, a lot of what's happened's been unprecedented. But clearly, in 2022, at least thus far, not a terrible year, but a rough year for the stock market. And yet,
Right.
economically, there's a lot of money out there. I guess,
Right.
do you see a disconnect between where we're at with the economy and where the market is? Or do you feel it's just a question of timing and that the market is anticipatory, whereas the economic numbers are looking backwards?
Right. This is another great question. All of them have been, but this is my big debate. We've done unprecedented things. We've talked about that. So we've put all this money in. We all this morphine in the economy, and technically, if we can set the bones in our broken leg, and the doctor is, really, really good, and that we might not need any morphine after that. Maybe ibuprofen is all you need, and maybe we will be able to have a soft landing, and everything will work out so that yeah, maybe growth slows, but the profits of energy companies offset the losses of Peloton and Carvana, for example. And by the way, anytime I mention a company by name, I am not suggesting you buy it or sell it. I don't do that. All right. I just use them as examples, so that, we can kind of think about how distorted the economy was. But that's I guess my biggest question is, we've never done these things, and can't, because we put so much money in, because there is so much liquidity in the system, will that cushion the downfall? And we just grow slow for a couple of years, but we don't really have a recession. And I think this is a big mystery. We're gonna learn a lot about the kind of government actions we just did in the next 18 to 24 months. My best judgment is that we will have a recession. I hope I'm wrong, but I'm preparing for a rougher road. We started off this year down. I think we were almost down 25% in the S&P, and then we've rallied back massively. We're not back at new highs, but if you would have held on, it's kind of it's not a great year, but it's nowhere near as bad as it started out. My belief, though, is that we're going to go back and test those lows, because I do think earnings were artificially inflated because of all the borrowing, and I don't see how we don't pay a price for that. I hope I'm wrong. I hope the bones get set perfectly, and ibuprofen is all we need, no more morphine, and we heal up, and we're back at it sooner than anybody thinks.
Okay, so final kind of question, and maybe any thoughts, although I think you just did a good job summarizing. Now, based on your experience, how do you feel both business owners and individuals should be looking at the next year or so, besides obviously allocating, have enough cash to ride out any volatility? Anything else that they should particularly be looking at or thinking about, understanding we don't have a crystal ball? And any other
Right.
closing thought?
No, you know what, Randy? This is the question we debate at First Trust, when we're together, and we do it all the time over the phone, email, etc. But the question we ask each other all the time is, a lot of us expect a recession. Not everybody, but a lot of us do. Is it going to be like the 1980s? And let me explain what I mean by that. Unemployment went to 13%. That's a really bad recession. Is it going to be like 2008, when people thought all the banks in the country were going to collapse and be gone? Or is it going to be more like the 1990s, which was a relatively mild recession? It was a recession. Unemployment went up 6.5%, 7%. But it wasn't like the 80s or 2008. And here's what I would argue is that the 80s were after over a decade of stagflation. We've only had a year of it. So this is not the 1980s. In 2008, banks they had a lot of I could talk about '08 a lot, but this is not 2008 because banks today have more capital and more liquidity and higher loan loss reserves than they ever have. We are at the least risk of having banks have serious financial problems today in my lifetime, maybe in the history of the United States. And a lot of it has to do with how strict the regulations have been on banks since the '08 crisis. Banks are I could never imagine one of our major banks getting in anywhere near the kind of trouble that they did in the early '80s or in 2008. And that leaves us with the 1990s. And that was a kind of a normal recession. Everything slowed down. There were some layoffs. Unemployment went up. I mean, obviously, if you got laid off, that was not a good time. But from a macro point of view, it was a kind of a relatively mild recession. And I'm looking for something like that. Maybe I would call it mild plus, just because we have to go through a correction phase because we borrowed all this money, spent it. It artificially inflated spending relative to incomes. It artificially inflated profits, and it artificially inflated government tax revenues even. And then the last point I would make is, especially for business owners, is that remember, people spent way more on goods than they would normally, and that has to correct. The second thing is that the Federal Reserve has held interest rates really low for the last decade. I mean, we've been at zero on the federal funds rate for 9 out of the last 15 years, not 14 years. And that's artificial. And so now mortgage rates hit 7, builders are slowing down, home buying is slowing down. But all of this is kind of temporary because we have a shortage of housing in the United States. So the idea that we can just stop building homes, that's highly unlikely. We have a shortage. And because of what happened during COVID, we're kind of have a shortage of cars too. The age of the fleet has gotten a lot older because there weren't as many new cars sold. And so we're just not overbuilt like we were in other periods. All we have had is this artificial stimulus that now has to go away. So the '80s, we were overbuilt, overinflated. '08, we were overleveraged. We are neither of those things today. And so I just look for something normal. I don't see how the stock market doesn't have another correction in here or downward move in a kind of a bear market. But it's not '08. It's not 1999. It's not 1980.
Well, thank you, Brian. I think, clearly the market always reaches new highs. It's not a question of if, it's more when, whether it's in
Right.
2 years or 3 years or 4 years. Our planning, as our clients know, is not really based on predicting because we don't know what we don't know. I don't think anybody saw COVID coming, but I do think with proper allocation and enough cash to ride out the storm, that people will be fine. So I appreciate you joining us. We will have this evening's interview posted on our website in the next week or so. If any of you wish to share it with your friends or family, we also have a number of other upcoming events you're welcome to share. Clearly, each person's needs, objectives, their personal vision are unique. Feel free to reach out to our team with any questions, or if we can otherwise be of service. We're always here to help you achieve your vision and simplify your life. So we appreciate you joining us. We greatly appreciate Brian taking time and First Trust Advisors. We hope you have a great evening. Thank you.